Welcome, everybody. We're so glad that you could join us tonight. My name is Mitzi Young. I'm the physician advocate for the Riverside County Medical Association, and I'm going to go through just a couple of benefits. This is just a really great time for folks to take a look at their benefits and see exactly what you're paying for with your membership and how to use them. And so we want to make sure that you guys are clearly aware of that. A lot of times I find that folks don't really know exactly what covers on the benefits. So we want to make sure that you have access to all of the COVID resources on our COVID resource page at the RCMA. Also, we want to make sure that if you guys need PPE, we've got free PPE available. And so here's the website that you need to actually go to and order. All you have to do is pay for shipping. And you can get that PPE within probably, I think right now they're doing a turnaround of about 10 days to 2 weeks. Also, vaccines for you and your staff. You can contact the Riverside County Public Health Department, and they can get the information from you so that you can get an appointment with that. Next slide. Okay, so again, we want to make sure that you understand together we are stronger. So your membership protects your profession. So what do your dues pay for on a legislative side? This is kind of everything that your dues are going towards. Obviously, we've got a big, huge microfight coming back up with the attorneys that are, that came after us in 2014. They're doing it again in 2022. So we are definitely campaigning right now for membership, and so that we can fight this for you on your behalf. Scope of practice, that's a big deal right now, obviously, with the nurse practitioners and the PAs being able to do independent practice on their own. And then, of course, Medi-Cal, Medicare, loan repayment programs, GME funding, and more. So these are the kinds of things that you have access to. Your membership empowers your practice. Practice assessments are done by me. I've got 30 years of practice management experience. And so I have run many practices and surgery centers in my career. We've got staff education like today, payer advocacy and intervention. So we will absolutely, intervene on your behalf at the Department of Managed Healthcare, the Department of Insurance, legal support, and toolkits, many toolkits to make life easier, and of course a slew of business partners as well. So these are the things that you're paying for in your membership, so we want to make sure that you are aware of them. Next slide. So this is kind of you're going to get all of these PowerPoint, of the PowerPoint presentation in your email. So you just need to know that these things will all be there for you. This right here is kind of gives you a catch-all of all of the member benefits available to you. Remember that all the benefits are free. So you already paid for them with your yearly member benefit membership. Next slide. Again, I offer free one-on-one consultations. Anything you could possibly think of that happens from 8 to 5 in your office, I can help you with. I can do in-person, I can do video Zoom calls if that's how you want to do it. Anything from practice staffing, operations, contracting, reimbursement, anything that you can think of, please let me help you with that. Give me a call if you guys are struggling. Payer information or payer reimbursement issues, make sure that you contact me. We want to make sure that we know everything that happens at the CMA for reimbursement issues that you may be having. Next slide. Tonight is 2 of our business partners that are vetted, very, very popular business partners with our members. So first off, we're going to just kind of go through what you get, because as a partner with, or as a member with our organization, you are also going to get discounts that otherwise you wouldn't get in the outside world. And they don't give them to anybody else except for our members. So Thakur Law Firm is going to be offering RCMA members complimentary consultations up to 30 minutes. 10% off hourly rates for pre-litigation, litigation, and hourly matters, along with flat fees for various contracts, agreements, and handbooks. So that's somebody you want to reach out to. Also, Westpac Wealth Partners will receive a complimentary financial EKG worth $5,000 to $10,000, depending on the size of your practice. which is a personalized website with complete financial data displayed as a living balance sheet. Additional financial and alternative solution planning fees will be waived when physicians choose to have their assets managed by Westpac partners. So these are really, really good things for you guys to have right now in the climate of healthcare that we're living in. So I'm going to introduce our speakers and send them off to Pamela. So meet our presenters. Today we have Jonathan Barrera. He's a financial planner with Westpac Wealth Partners. And first up on deck is going to be Pamela Tucker. She's Esquire attorney at Thakur Law Firm. So if you would like to contact either one of them, they will give you all their contact information at the end of the presentation. We ask that you put all your questions in the question box, and we will get to those at the end of the presentation with our presenters. And with that, I'll hand it over to Pamela.
Hi, everyone. My name is Pamela Tucker, and it's our great honor to be here today. And actually, we will be starting with Jonathan Barrera, who is a financial planner, and he will be starting this presentation. I will be speaking later, discussing the basics of estate planning. So Jonathan, if you want to go ahead and take over and introduce yourself. And as soon as you're ready, I'll share my screen and we'll go from there. Thank you.
Wonderful. Thank you, Pamela. So welcome, everybody. I'm super excited to be here with you this evening. I think we have a lot of very interesting and thoughtful things to share with you today that you'll be able to take with you for this evening, and hopefully contemplate on ways that are going to just add some education, add some consistency, and add some thoughtfulness into our planning in general. I want to thank Mitzi and Richard and the RCMA team for allowing us to be here today and share with you some great information. So just so you have my information here, I'll also show this at the end of the presentation. So we'll go ahead and get started. But my cell number is there. I'm always available to you're always available to call me on my cell at any time. My email is there as well, j_Barrera@thewp2.com. So just a little bit about what we're trying to achieve today. I think the essence of the life we live today, there's so many things going on. There's so many changes that have occurred in 2020. And really, I think we're all looking for simplicity. And we love to take the word simplicity and bring that into the style of education and understanding how we can improve our life just from a healthy financial standpoint. With so many things going on, so many stress points, so many things going on in the financial markets, in our personal lives, in our business life, isn't it nice to think about ways that might simplify things? So the question I always ask anybody that I'm working with is, how many people are actually helping you to use your capital efficiently in your life? And it's kind of an interesting question because I think we have a lot of resources available to us and a lot of individuals in our life, but how many of them are really helping us understand capital efficiently? So we take pride in simplifying that by looking at the overall process within a financial standpoint and providing that education and simplicity to help weigh down some of the complexity and confusion when it comes to planning in general. So we're covering financial, we're covering estate tax, we cover some of the controlling issues of assets and charitable planning, how to protect all the assets that you work so hard for, as well as business planning in specific. We are just very, very excited to work with the medical realm in general. I would say that 95% of our clientele are private practices and or working physicians. So we take pride into working into the medical field. And, part of that is really truly understanding your financial lifestyle. And in your financial lifestyle, I think there's a building process that we all should consider in an organized process. So we know what we need in life, the education that we can utilize to empower and better ourselves. And so one of the things that we do is we have this building process that we take pride on, and it's really a 4-step process. First, we look at focusing on the why. I think a lot of individuals may have heard of Simon Sinek and asking yourself who your why is. But how beautiful is it to understand who you are and why you do what you do, whether it's your career, whether it's your focus, whether it's your objectives in your financial lifestyle and your personal life. I think it all kind of realms around your financial life. And I think if you can understand what your why is with finance, it could be a very powerful thing to help you understand how to take the next steps forward. And it may even improve relationships, less stress in your job. And so many things involved, like debt and the evolving understanding of what can we do to relieve some of the unknowns of retirement, saving, the markets, all the anxieties that finance can bring. I think knowing your why is a big deal. So we spend a lot of time understanding the why of our clients and optimizing the financial instruments that you have in place. How many individuals do you know that have a basket of financial products lying all over the place in the household, but you have no clue what they are, or have no idea, or multiple advisors that may not be steering you in the direction of understanding how they work congruently? So that is a big thing. And when you're optimizing your financial instruments, you should be organizing them. So we'll talk about that here in a second. Understanding efficient saving strategies. I know it sounds like a cliche or a very simple thing, but you'd be quite amazed in how many individuals we work with that don't understand simple saving strategies. So understanding how money works is the final step, and that will help you understand the myths of return, rate of return, and opportunity cost. We'll talk about that in a little bit, but I think many chase rate of return without truly understanding how money works. And it's a beautiful thing to understand some of the education we're going to talk about today that'll bring that in fruition. So the next step is really the pyramid, and that's really part of the building process. And so understanding the protection piece, your foundation of your life, and planning for different things that come about in an everyday situation, prioritizing those goals, and really understanding risk and diversity and the different powers of inflation and taxes that help us then understand how we can do a progressive way of planning and look at what are we going to do for our heirs, our church, our community, our family. So that's a little bit about the process in itself. Now, this is the living balance sheet that Mitzi was so kind to bring up as something that's available for each physician that we work with. How powerful is it to organize the way you see money flowing in your life? And as I mentioned earlier, you may have the inconsistencies of understanding all the things that you have and how they work. And what we do is we look at things kind of like an infrastructure of a house. You always have to protect everything you have in your house. And the question is how are the risks related to your career? How are the risks related to your income and your health? How are the risks related to understanding how to focus on what would happen if something happened to me, whether it's disability or a unforeseen event in our life, and understanding how those assets are to transpire to our heirs and or charitable organizations. And then the next level is obviously what happens if I pass away? How do I make different decisions and smart decisions from not only a tax efficiency standpoint, but putting back maybe income that could have been lost in the household otherwise? And then after we look at the risk management of an individual and their family and their business, actually, we incorporate the practice in this equation. And when we can understand our assets, we can understand our liabilities, we can have a real functioning manner of looking at what our net worth is on a daily basis, real time. How powerful is that to be able to organize everything that you have that's all over in different places, but it's right there on one screen. And what's powerful about this is if you sit down, with your advisor and you're looking at all the things that are involved in your life, it takes away some anxieties because you truly understand the rhythm of your flow of money. And then finally, your cash flow, which is the foundation. We look at the business, we look at the individual, we look at other alternative sources of income that come into the household. And isn't that important to keep track of your inflows and outflows of your money, all absorbed into one place? There's a lot of working tools and just a lot of consistencies that have to happen behind the scenes for this to look the way it does for you. But just to let you know, this is probably one of the most powerful tools we work with physicians on, because you work so hard, you have so much going on, and things are moving so fast. How beautiful is it to see it all in one place? So on the next slide, what we're going to start doing is we're going to look at examining how taxes work. We're going to discover some strategies that might help some of your tax mitigation, and then address some things like how diversification works and how risk tolerance works. So the value of the dollar, it's quite interesting, because the value of the dollar, if you were to double your dollar for 20 years, you'd have over $1 million in your bank account. But a lot of people don't realize that because of taxes, if you were taxed on that double growth every year on that dollar, you'd actually walk away with $51,353 rather than that million I just showed you. That is the power of what a 28% tax bracket gets you. But as many of you might know, in the state of California, when you include California and federal, you can very well be close to a 52% tax bracket, and that's just no fun. So there has to be a remedy to that. So let's just quickly look at tax tables for 2020. I want to look at maybe looking at this 24 to 32. That's really a sweet spot for many of our clients. But imagine being in this area and having to pay this 24 to 32%. But oh, wait a minute. We might have capital gains that we have to deal with at the same time, and that's going to be somewhere between 15 and 20%, depending on what types of assets we're pulling from, or if we sell our practices. These are things that we have to understand and plan for way ahead before they happen. And I think having a guide is the most beautiful thing that we could ever have in our life. Having a guide makes us make smart, definitive information, helps us make smart decisions and carry forward with doing things that are going to benefit us in the long run. And so thinking about educating and having a decent amount of time to make a smart decision is remarkable. So if we look at in 2020, how crazy is it that in the state of California, it's the top #1 state in the country when it comes to overall taxation, when you're in the top tax bracket. This is what gets us to that 52% if we're in that situation. Very mind-numbing when you think about it, but there's ways to fix that. And all it is education and understanding what your options are. So this is a pretty interesting chart in itself, because in income tax, many look at rate of return, and rate of return is just one part of the situation. When we look at math and total, in this case, if I was in a 28% tax bracket and I wanted to get a 7% return on my money, because I'm taxed on that money, I'm actually walking away with 9.72%. Or I would have to actually make 9.72% to walk away with 7%. And vice versa, if I look at this chart, it's pretty crazy, because it says, hey, if I made 10% and I had to pay 28% in taxes, I really walk away with 7.2%. So very, very powerful if we understand what's behind how money works and how the mighty dollar works for us and how other things come into play, including opportunity costs that I mentioned earlier. What do you miss out not being in a certain situation? And we'll look at that. But the big question is, how do you feel about taxes today, and where do you think they're going to be tomorrow? If you think that you're paying a lot of money in taxes today and you're a licensed professional, look to understand that, especially with the $1.9 trillion bill that's just about to get finalized, in addition to the other trillion-dollar bills that have been passed in 2020 and 2021, we have to think about, what are we going to do to mitigate our tax liability out into the future? And the only way is to educate yourself and know your options. And so we feel that taxes are most likely going to increase, and that will affect everybody in the future's income as well as their retirement. And I'll tell you what, Social Security is not tax-free. Most retirements are not tax-free, and most assets you sell are not tax-free. And they're even talking about the capital gains changing to ordinary income tax. God forbid that changes, or estate tax changes. Many things to think about, and I'm sure Pam is going to touch on some of this stuff. So let's look at rate of return in itself. What type of investor are you? Well, going from conservative to aggressive. Let's look at where that takes us. If we were to start at the beginning of time and put our money in the markets, it's plain to see that we would make decent money, whether it be small caps, large caps, government bonds, treasuries, or inflation, which eats away from our money. And if we have the ability to plan for inflation and have the ability and time to save, it's going to be a remarkable situation to have a guide and have some education as to understanding, what does our money mean from a short term and a long term. But it's not just about the rate of return. The psychology behind it is, if the markets go down, I might start getting scared. Or if I feel like I'm missing out, the old FOMO conversation, like many are right now, we should have all put all of our money into Tesla yesterday in the morning, shouldn't we have? So these are things that we all must discuss. But with our clients, we look at short term, midterm, long term, and really try to understand the fact of what type of education is necessary to prevent psychological infiltration to making bad decisions, maybe pulling at the wrong time, or pulling in different buckets that shouldn't be pulled from because they're taxed a certain way. Very powerful to understand the psychology of rate of return. And this is very interesting. If we look at the history of the S&P 500, here we are. 74% of the time, the S&P 500 has been in positive territory. So long term, probably a good idea to have your money working for you, and bonds don't seem to be doing much. And then dollar cost averaging, you're probably doing that now with your current retirement plan. And all this means is we're buying in incremental periods of time at different price points, and most likely it stretches the ability for you to pay less for an investment and have more shares of that investment by dollar cost averaging. Another very pure but powerful way of planning. In this circumstance, we like the power of tax-free options. In tax-free options, in this equation, very simply said, what happens here is, if I were to take my $1 million and withdraw 80,000 from my accounts, and I had down years during my 20 years, I would, and I had these down years here, 173, 592, and 15.88. How do I simplify the understanding of having more money in my pocket? Well, here's one theory. If you were able to use tax-free money during these down years instead of pulling your money out of taxable assets, watch what happens. 1.3 million. And all I did is, on my down years, on the following year, I was able to stay away from taxable assets or take minimum amounts of money out of taxable assets and pull from tax-free assets. and it just extends my money. It allows me to live longer on my money, making smart financial choices and maximizing tax efficiency. But guess what? You have the flexibility and control to do it. And it's very nice to have a guide there with you to do that with. So just to wrap up a couple things on a practice standpoint for those of you that have a private practice, it's very important for you to understand how taxes work with your practice. Most of you are familiar with the revenue goes through the business, you pay your operating expenses, and then at the end of the day, you have profit. But the question is, do you take that profit and distribution and pay 52% on it in the state of California? Or do you have something you can utilize? Well, we are perfectionists at finding ways to do that. And what we do is we look at each individual. What is your why? What type of business are you running? What type of practice is affecting you? And we look at that and we say, here we go. This is where you fit in the big picture. What type of deduction do you need? And our solutions will give you a dollar for dollar deduction. And that type of education is truly necessary to understand, because if you were able to put $100,000 to $300,000 of profit away that you didn't need to live on, and you got a dollar for dollar deduction on it, and in this case, the normal individuals putting maybe $25,000 a year for retirement, this is a huge acceleration to retirement for you. So when we talk about burnout, when we talk about working our butts off and all the stress that's involved in to the things that we do, how powerful is it to have a vision and a clear understanding of where we're going to be in the future and what tools we can utilize to accelerate ourselves into retirement, just because we know our options and education on doing so. And for our clients that are in the upper, say 55 and above, usually close to 60 years old, we're able to get up to 1.25 million per partner in there if the profit were to exceed that. But as you can see on the scale, it doesn't matter where your practice is, it's a matter of where you want to go. So that being said, what I want to do is I'm going to pass it along here to Pam. Pam is a wonderful individual. It's a pleasure to be able to work with her. She specializes in taxation here and is a former chair of the Orange County Bar Association healthcare section. Pamela represents clients in a full range of trust, estate, healthcare equipment, and business matters. She works with clients to handle all areas of estate planning and trusted administration and contest trust litigation matters. She has been rated as the rising star for super lawyers from 2017 to 2019, and also for 2020 and 21. I'm so excited to change the screen here and pass it on to Pam.
Talk about the basics of estate planning for physicians. So I do have an LLM in taxation, and I've been representing physicians for over 15 years. I started off actually at a tax firm, and I felt that I wasn't utilizing my legal degree. I really wanted to get into helping physicians and their medical practices in different areas. But estate planning is a huge part of my practice. And the reason that estate planning is so important is that if you don't have an estate plan set up, what will happen is that your assets, everything will go through probate. And physicians are very busy with their practices, and probate is not something that you want your family to go through. Probate is a very lengthy legal proceeding. If you don't have something called a revocable living trust, where you have transferred your assets to, including your ownership interest in your medical corporation, your real property, your investments, any other property, what will happen is that this process will take at least 2 years now with the way that the courts are impacted. And it's a very expensive process. California is one of the only states in the nation that has statutory attorney's fees. So depending upon the size of your estate, if you do not have something called a trust, a revocable living trust, all of your assets will go through probate in order to pass to your children. This applies to anyone with assets over $150,000. So if you have any real property in California, you need to have a trust that is set up to protect your family and your assets from probate. So the statutory fees, let's just go into this. So the reason you want to avoid probate is because of the fact that it is very expensive and it's time consuming. So taking a look at the slide here, if you have, let's just say the size of your estate is $3 million, your family will pay in statutory attorney's fees $43,000 to the attorney who is handling the probate. That is a huge windfall for any attorney. And that's why attorneys who are involved in probate work, if they have a large estate, they make a lot of money. You can avoid all of this by setting up a trust, which is much less expensive than spending $43,000. So this is another issue with probate, is that creditors will be notified that you are in probate, and all of your assets and everything regarding your personal financial status will be made public, and creditors can make claims within 4 months. So as I mentioned, the number one strategy to avoid probate is to set up a trust. It's a living trust. There are other ways to avoid probate. I do not recommend them, but we can discuss them. One is a payable on death account. There is something also called a revocable transfer on death deed, that if you have a real property, you can prepare this deed, and a spousal property petition. So the living trust is the key instrument that you would need. And essentially, if you and your spouse are married, you would set up a family living trust. It also protects financial privacy by setting up a trust. When you have a trust, it is generally revocable. So what this means is that if you and your spouse are alive, you both can make changes at any time. And you both would be trustees of your trust. You would designate your beneficiaries. And if you are married and one spouse passes away, only the surviving spouse can make changes. You cannot make changes for the other side's wishes. So this is very significant. If you have a trust in California, there are ways to protect your assets that are extraordinarily important. So when a physician dies, the California Medical Board needs to be notified of a physician's death. A copy of the death certificate needs to be sent. So one thing that you can do in a trust is that you can designate a physician to actually manage your medical practice. So in California, only a physician can run a medical practice, as you know. So California law does not allow non-medical professionals to operate medical practices. And so in your trust, what you can do is, in order for your spouse to take over the medical practice and sell it, what you can do is you can designate who can actually run your medical practice. And so that will give your family an opportunity, time to either sell the medical practice or allow another medical professional to run the practice. And that's the best thing that you can do. As a medical professional, you want your beneficiaries to get the best price for the sale of the medical practice. So by setting it up in the trust and designating who would be running the medical practice, you are giving your family the ability to then get the best value for the medical practice. If your practice has more than one physician, then you would want to have something called a shareholders agreement, which has provisions about how the deceased physician's shares will be transferred. So if you are a solo practitioner, in your trust, it is important to select another medical professional, so that you can preserve the value of your practice for your beneficiaries. Now, the other key document that you need to have as a physician is something called a pour-over will. So a will alone in California does not avoid probate. You need to have something called a pour-over will. So in the event that you set up a trust and you do not list all of your assets to transfer into your trust, what the pour-over will does is it states that it was your intention that all of your assets were to go into your trusts, so that in the event that you forget to include an asset, you don't have to go through probate. And again, there's another process called a Hegstack petition. So if you have a pour-over will and you state that your intention is to transfer all of your assets into your trust, then all you have to do is file this will with the court and file a simple petition called a Hegstack petition. So this is the second most important document to have for estate planning. And the other benefit of a pour-over will is that, or any will, is that you can designate guardians for your minor children. So if you can designate guardians for your minor children, and if you do not have a will, then the state will choose an administrator, the court will choose an administrator for your estate. So the court will also appoint a guardian for your minor children. So having a will is significant because then you are selecting who would be managing all of your assets as the executor of your estate. So in the event that you don't have a very large estate of $150,000 or more, you can get away with just having a will. But if you have over $150,000, which most physicians do, then you would need this pour-over will in connection with your trust, so that any assets that you have that you may have left out of your trust, that you have listed as part of your trust, would be in the pour-over will. Now, a lot of times clients come to me and they'll have a trust, but the trust will not be funded. And that is a huge problem. So one of the things that you need to make sure when you set up a trust is that you actually list every single asset that you have, and that you have an attorney that knows how to prepare a trust transfer deed to transfer your real estate, your real property, into your trust. If you don't do that, then it's essentially an empty shell. So that is when you would need something called a Hegstack petition to make a petition to the court to order that the property be transferred into your trust. Now, the third most important document that you all would need and that you're familiar with is something called an Advance Healthcare Directive. The Advance Healthcare Directive is something that comes into play, as you know, if an individual is not able to make his or her own decisions regarding healthcare, if that individual is incapacitated. And by having an Advance Healthcare Directive, you can select who would be making your healthcare decisions for you. And in addition to that, you can also designate who you would want to be your conservator, so that the court doesn't order it in the event that you are unable to care for yourself. The conservator process is a very expensive, very consuming process, and you're looking at spending at least $10,000 to $20,000. Not only, just these are just court costs. There's an investigator that is provided by the court that is required to investigate and determine whether or not a conservatorship is necessary and whether the person who is filing the petition for the conservator is the appropriate person to be doing so. So the costs alone are between $10,000 to $20,000. So you could simply avoid that by designating the agent for your conservator in your Advance Healthcare Directive. So this is the third most important document. And in addition to that, there's a famous case known as the Terry Schiavo case. And this case involved a dispute between the parents of Terry Schiavo and her husband, where essentially for years this woman was kept on life support because some of the family members wanted her to get off of life support, and her husband did not want that. And what ended up happening was it depleted their finances, and there were a number of costs. This was in litigation for a number of years, and she was in an irreversible coma, and ultimately she passed away. So by having this document, you are preventing this situation for your family. You're preventing huge medical bills and expenses, and you can designate in there that if there's no chance of survival, that your agent can make a decision on your behalf to remove you from life support. Also, in addition to this, you can state whether or not you would like organ donation or not, whether or not you authorize an autopsy, whether or not you want to live in your home as long as possible, or go to a nursing home facility, and what type of funeral arrangements you would like to have. You can also designate religious preferences and end-of-life instructions. The fourth important document for physicians is something called a durable power of attorney. This is not an automatic power of attorney, but in the event that you become incapacitated, by having this document, you are designating who would be your attorney in fact. Who would be handling your finances in the event that you are unable to do so? This also, again, avoids a conservatorship. There is a conservatorship that could take place over a person or over a person's finances. By selecting someone who you find is responsible to handle your affairs as your attorney in fact regarding your finances, also will save you a great deal of headache in the future. Generally, you want to select the same individuals that you have selected to handle your trust as your successor trustee. Typically for a married couple, the way we see it is that a husband and wife couple, they will select each other, and then they will have successor trustees for their trust. They will have successor executors for their will, and they will have successor executors, attorneys in fact, for their power of attorney. And this also avoids the necessity of a guardianship. So this is the fourth document that we would recommend. There is also something called a regular power of attorney, which can be automatic. And then there is the springing power of attorney, which is in the event you become incapacitated. For most of our clients, we prepare the springing power of attorney, which only is in effect in the event that two physicians deem you to be incapacitated under penalty of perjury in the state that you reside, or you are determined to be incapacitated by a court of jurisdiction. A court in the jurisdiction that you reside. So no one can just come in and take over your finances. And this is also significant because if you run a medical practice, you can designate someone who would be able to continue with that in the event that you are incapacitated. And if you are a solo practitioner, it is absolutely critical that you have these documents in place, because if anything happens to you, notification would need to be provided to the medical board, and it's better for you to select who these individuals would be rather than the medical board doing so. Now, with the estate planning and estate tax exemption of 2021, this has gone up significantly. So the estate tax exemption for an individual is 11.7 million and 23.4 million per couple. So if your estate is above 23.4 million per couple, then there's additional advanced estate planning that we would recommend as well, including setting up something called an irrevocable life insurance trust. And so by setting up something like that, a more advanced technique, what you can do is you use the life insurance proceeds to essentially help your beneficiaries to pay any estate taxes that would be above and beyond the $23.4 million exemption amount. Now, as part of estate planning, in setting up a trust, you can have a simple trust if you're a single person, or you can have a more complex trust, which allows for some form of creditor and asset protection within the trust. This is known as the ABC Credit Shelter Trust. And within this trust, what you do essentially is if one spouse passes away, that person's share is known as the bypass irrevocable trust that cannot be changed by the survivor. So this prevents a situation where if someone passes away, the surviving spouse and a new husband potentially cannot come in and touch those assets. And the beauty of having that type of credit shelter bypass trust is that you would essentially be able to transfer highly appreciating assets into that trust that would not be taxed on further. You wouldn't. So essentially, you would be able to transfer appreciating assets into that trust that could grow without paying further taxes for your beneficiaries. So essentially, not only is it to provide some form of creditor protection, asset protection, you also have some tax benefits by setting up a trust like that. It is important to discuss that with any estate planning attorney because in some situations, depending upon what types of assets you have, you may not want to proceed with that strategy because there's something called a step up in basis. So if you have a bypass trust and one person passes away, then the step up in basis, it would be as of date of death for that decedent at that time. Whereas if you don't have this type of trust, it would be at the death of the second spouse. So it's important to talk to an estate planning attorney who goes over the assets that you have to discuss these strategies with you as well. And this technique was primarily used back 10 years ago when there was not a double estate tax exemption where you had to have this type of trust. But there are now in play you don't necessarily need to do this in order to take the double estate tax exemption. Now there's a new Proposition 19 that has come out, and a lot of people have asked questions about this. So what happened was, based upon this new legislation, essentially this was to prevent transfers between parents and children for properties that were not primary residences from property tax reassessment. So this came into play actually in November, and the deadline for transferring any assets, any real property between a parent and child to avoid property tax reassessment had to be done by February 15th. There is some new legislation lobbying that's taking place to essentially reverse this. So basically, a lot of families, what they were doing is they were trying to transfer real property to their children or vice versa prior to February 15th, so that if it was not a residential property that both were living in, that they would be able to capture the property tax exemption. So now, if you have a property that you're transferring to your child, for example, and it's a rental property, the property taxes will be reassessed. And there are certain strategies that estate planning attorneys are talking about. This is very litigious at this point, and there is lobbying in place regarding dealing with this in the future. And that's actually it from my side. So Jonathan, if you wanted to say anything else, that is it regarding the key estate planning documents for physicians.
Thank you, Pam. I really appreciate it. And I just wanted to say thank you for everybody's time this evening. It's a remarkable opportunity to be able to speak with you this evening. And hopefully Pam and I can be a resource to answer any questions that you might have. As Mitzi has mentioned, as part of your membership, you get these exclusivities to be able to talk to us and go over some of your questions that you might have. There's no question that I don't think Pam and I can answer. As a team, we're here for you, and we're here to do whatever it takes to make sure you're educated and you can make great decisions with your planning going forward. Uh, Thank you again for all your
Okay.
time today.
Oh, sorry.
And sorry we had to have it kind of short, but we also wanted to keep it sweet and make sure we respected everybody's time. But we can definitely take things offline and customize the conversation to you.
And I've
Thank you.
got a couple of questions.
Oh,
So
great.
I'm gonna, yeah. So the first question is ways to save corporate taxes, corporate investments to reduce taxable income.
Sure. Pam, I'll jump on that one.
Yeah, that's you. Go ahead.
There's a couple ways to do it. Of course, there's streamlining and trying to burn the money as much as we can to try to get some tax deductions. But as you know, not everything that you buy is dollar for dollar deductible. So we like to look at things from a lean concept and say, well, what if you were able to get a dollar for dollar tax deduction, take it from one pocket, which is the corporation, and put it back into your pocket, which is the individual, the owner? And the way that you can do that is by utilizing what are called QRPs. So these are what are called qualified retirement plans. They are actual trusts that are created for retirement. They are entities of their own. So the profits of the corporation can go into the trust, and the money there now sits to help facilitate towards retirement income into the future. In addition, there are some tax efficiencies that go along with it, and some additional planning tools that you can utilize through the corporate profits to assist with estate planning, medical expense planning when you retire for you and your spouse. In addition to that, can help with buy, sell, and maybe transitioning out of a practice, like selling it to another physician, or perhaps retiring out of the practice, or a partner buying you out. So that's some of the ways, and the most efficient ways that we help physicians minimize their tax liability and help mitigate some other risks that come into play as a physician.
Great, thanks. Our next question is there simple investment strategies for physicians, nurse practitioners, physician assistants to secure retirement?
Absolutely, 100%. The beauty of powerful planning in specific is when you're able to set up a retirement plan that has sophistication for each level of type of employee. That's really where you've got a win-win. Obviously, owners are going to have a substantial amount of profits that they might want to do something with. If they don't need to live on the profits of the business. You're either going to pay taxes on it to California and the federal government, or you're going to shove that away. So for the benefits of the owners, it's a win-win. But what about the individuals that are a part of the practice itself? What if you were able to give those individuals just as much ability to have access to investment strategies that would assist their retirement and benefit them, and also be able to incentivize the individuals that are helping the practice to build to where it is? So most definitely. And what's really intriguing is the financial industry is going through a very significant overhaul. Back in the day, you used to have these 401ks, and it's still today. I mean, mind you, the banks really control a lot of the retirement out there. But when you start to look at really understanding what your true need is, like what's your why of your business? If you understand your true need, you can actually do a very customized type of retirement plan. And instead of being forced into, say, a menu of mutual funds, you can actually have 401ks and pension plans that have access to ETFs, So you're lowering your expenses, you're lowering the retirement cost. That puts more pocket in the employees, the managers, the facilitators, and the managing partners of the practices. I hope that helps.
You're on mute.
I sure am, and I'm just talking away over here, everybody, just so you
No
know.
worries.
Zoom meetings, they're fun.
Yeah.
Yeah. So what is the difference between revocable and irrevocable trust? Does it matter if you move out of state as far as trusts are concerned?
Yes, definitely. So a revocable trust means that you can make changes to it while you're alive. An irrevocable trust means that you cannot. And so you need to be very careful if you're setting up an irrevocable trust. Generally, those are set up as irrevocable gift trusts if you have a large estate and you're gifting and you're transferring assets to your children. So I see that a lot, if it's over the estate tax exemption as a way to lower your estate taxes. But you have to be very cautious when you set up an irrevocable trust because you cannot make changes to it. And so you would need court approval to do that.
Okay.
And,
and again, still on, sorry. Did you have
no,
more?
and then just answering your question, yeah, if you move out of state, then you would need to set up a trust based on the laws of that state. So I do have people who are not based in California and they ask me if I can set up a trust for them, and I tell them I really can't. We're only licensed here in California. You'd have to hire an attorney who's based in that other state. So we can set up an estate plan for an individual who is filing taxes in California, basically.
Okay, thank you. And still with irrevocable trusts, can they protect assets from creditors? Will it also protect my properties from fraudulent situations, such as a quick deed of my home without me knowing? Who do I put in charge of my irrevocable trust?
So an irrevocable trust is the way it is becomes irrevocable is essentially you're giving up your ownership interest in a way so that you end up becoming a beneficiary. So a trustee for an irrevocable trust would not be you. And that's why they're not highly recommended and you don't see those very often. But it's on a case-by-case basis. So if someone has a question and is interested in setting up an irrevocable trust, that's something we can discuss. There's something also called a qualified personal residence trust. It's a strategy in the event that someone wants to basically prevent creditors from reaching their residential property, and there's a lease agreement between yourself and whoever is going to be trustee of the trust so there are different strategies in place, and it's a case-by-case basis that we need to speak to the individual.
Pamela, thank you so much. Jonathan, thank you so much. Just a few reminders. You're going to get a survey. We would really appreciate it if you would fill that out for us and shoot it back to us. Also, we want to take time to make sure that we thank our co-hosts today, Inland Empire Health Plan and the San Bernardino County Medical Society, along with the Riverside County Medical Society. Please make sure that you give us a call for anything that you need. We can make life a whole lot easier for you every day and your staff. And with that, I will say goodbye and thank you.